So let me kind of continue where I was. I'll circle back to the individual stuff. I want to make sure we get through this. So pass-through rate, as we discussed, pass-through rate 25%. Compensation rate is going to be at the much higher rate, up to 35%. Full expensing we talked about. Depreciable assets would be fully expensed as proposal. We expect actually that may not happen, that we get the lower rates and full expensing. It'll probably be some combination. And then net interest expense would not be deductible anymore. International reforms. So Trump would like to have a deemed repatriation of all the funds that are sitting offshore. You may recall we tried that again back in 2000. We tried that before back in 2004, where all the funds owned by foreign entities, which may be sitting in U.S. accounts, by the way, but owned by foreign entities, foreign subsidiaries, would be deemed to be repatriated back to the United States. The idea being then there would be no tax cost in bringing that money back to the U.S. and it would be reinvested in U.S. infrastructure jobs, etc. It may actually be distributed to shareholders or paid in the form of higher compensation and bonuses. Border adjustability, the BAT, as I said, is gone, so we don't have to talk about that. But here's a very, very big provision of the new proposal, is a territorial tax system, which brings the United States in line with most of the industrialized world. And what that means is that only the U.S. income is taxed by the U.S., foreign income is not taxed. And the way that's implemented is by exempting dividends from foreign subsidiaries. This would mean that our Subpart F regime, which is our current tax law, which taxes U.S. companies on on earnings, foreign earnings of its U.S.-owned foreign subsidiaries, would not be taxed, would probably have to be replaced. It isn't really needed anymore, since that foreign income is not going to be subject to tax, even if it's repatriated as a dividend. Now, one thing you should keep in mind here, because I have seen some commentary about this already, that people say, well, gee, we're going to give the wealthy a big tax loophole because they can just park money offshore, leave it offshore, let mobile passive income grow through dividends, interest, and capital gains. But that is not quite how this is going to work out, because there has been proposed, people have thought of this, there will likely be an exception for passive income. So in other words, that passive income will still be subject to a Subpart F regime, which prohibits people from parking money in U.S.-controlled foreign corporations to grow tax-free. Estate tax. The framework would repeal the death tax and the generation skipping transfer tax. Death tax is not defined in the code. I think what they mean is the estate tax, and probably, possibly the gift tax along with it. But the estate tax is the tax on a decedent's estate at death. This is interesting because there were two different proposals on this beforehand, and I'm not sure, based on this unified plan, what they're talking about. There's going to have to be a lot of detail filled in on this. So a few things you should note about this. Number one, the estate tax is probably the most voluntary tax we have. It's one that it's pretty easy to avoid through proper planning. And as a practical matter, very few estates actually pay an estate tax. And it's not even the estates that you would think. It's estates that just don't do any planning. In fact, you may have heard that some of our most prominent billionaires in this country have been, very big advocates for the estate tax and opposed to its repeal, which seems like a very altruistic thing for a billionaire to say, no, don't repeal this tax that would tax me at death on my billions of dollars. But in fact, those people will never pay the estate tax under current law. They will transfer it to family foundations and avoid it entirely. Now, the Trump plan would have shut that down, because the Trump plan would have had a mark-to-market step up and would have had a deemed sale of assets at capital gains rates at death, which is probably worse than an estate tax, and is certainly worse for anybody who thought, who under current law would transfer their assets to a family foundation and still have their name on those assets for, for the next 200 years. That would go away. It would be an increase in tax for those folks. The House plan was a little different. They talked about a repeal of the estate tax with no substitute, no step up, no deemed sale, but that's going to require that the current law step up and basis would go away, otherwise assets would escape tax altogether. So what I mean by that is under current law, assets get a step up to fair market value when somebody dies so that the heirs can sell it free of tax. In other words, basis equals value, so they pay no tax. If you don't have an estate tax and you do keep the step up, then those assets would never be subject to tax, estate or income tax. So there's going to have to be some additional thinking around this as to exactly how this mechanism is going to work. I think the thing that makes sense is if the estate tax gets repealed, the asset should not be stepped up and the heirs should take it at a very low basis, so when they sell the asset, they pay tax. So generally, what we have is a lowering of rates, a broadening of the base. And by broadening the base, I mean getting rid of a lot of these deductions that we had talked about, state and local in particular, state and local tax deductions. The plan aims for revenue neutrality. What I mean by that is it's not going to raise more money, it's not going to cost any more money, but revenue neutrality is somewhat of a relative term because in making that determination, the tax writers are looking at what we call dynamic scoring, or a system that takes into account the macroeconomic effects of the tax increase. So let me give you an example. A tax provision, say a tax change that, say the state and local income tax deduction, suppose we eliminate that deduction, you wouldn't expect that to have any real impact on increasing the amount of revenues other than if you turn the world turn America into a giant TurboTax and just recalculate taxes. You wouldn't expect it to generate any additional income. On the other hand, the provision that would allow full expensing, well, you would expect that to result in additional purchases of equipment. So those additional purchases would generate additional tax revenue, and dynamic scoring would take that additional tax revenue into account. So it's revenue neutrality is what we're aiming for based on a dynamic scoring concept, which is, I will tell you, a highly controversial and difficult to measure concept. Corporate integration, we didn't get it. It's not in this plan. It's still 2 levels of tax, but the tax levels are pretty low. By the way, the Senate Finance Committee plan, Hatch's plan, had proposed most recently a 40% tax deduction, a 40% deduction for dividends paid. So in other words, corporations, suppose they were at 35% rate, but they get a 40% deduction for dividends paid out, works out to something around 20% rate of tax. So the Trump plan or the unified plan sort of comes out where the Senate finance plan would come out without the corporate integration by just simply and more directly reducing the rate of tax on corporate income. And of course, you will often hear this is all about competitiveness. The U.S. has a very high top rate of income tax. Again, as a practical matter, and we have a worldwide tax system, which puts us on a different system, and we have no VAT, which puts us on a different system than the rest of the world. As a practical matter, what we've been doing is self-help all these years in self-help territoriality and moving income into tax havens, in figuring out ways to get big deductions, the creative use of the R&D credit, things like that. But it's been a difficult process to get that rate of tax down in the U.S. This is sort of a simpler and more direct way of putting the U.S. on the same system as everybody else. Now, I know we had some technical problems and you lost me on the individual reforms, so I'm going to go back to that for a minute. The individual reforms will reduce the rate, the brackets from 7 to 3, 12, 25, and 35 to eliminate most itemized deductions, but not charitable contribution or mortgage interest. So that'll stick around, but is proposed, or is expected, I should say, to propose the elimination of state and local tax deduction. That's a big, big deal here in California and some of the eastern states where state taxes are very high. Other individual tax incentives. One thing you'll notice is that this plan does not have a proposal that was floating around that we thought might be in the plan called Rothification, and that is the idea that we would force a deemed conversion of everybody's retirement accounts into Roth plans. A Roth plan, so currently retirement plans are paid with pre-tax dollars. In other words, you get a reduction in your taxable income for amounts put into a retirement plan, but then you pay tax on the amounts when it's paid out on the back end. The way a Roth plan works is just the opposite. You get no deduction for the amounts put in. You get no deduction for the amounts put in, but you also don't pay tax on the amounts that come back out. So there was a proposal to let's Rothify everything and not give people a deduction. In fact, treat the amounts that are sitting in retirement accounts as taxable income now, but then no taxable income on the back end. That didn't make it. Child tax credit will be expanded. Alt min tax would be repealed. Corporate tax, I think you may have heard this. The proposal is a 20% top corporate tax rate, repeal of corporate A&T, keeping the R&D credit, also keeping the fair housing, the housing credits, low-income housing credits, and full expensing of depreciable assets except structures for the next 5 years, and then interest deductibility, disallowance of net interest expense. So what does this mean for you, all of these proposals, which you can read more about on our website at rroycelaw.com in the Education Hub. We have a lot more commentary about it. So let me give you a few of my thoughts on where I think things will go. So like I say, I think we'll get some form of increased depreciation or full expensing, but probably not 100% full expensing in addition to the big tax cuts. I don't think the budget can take that. So, but you should expect that there will be some sort of form of full expensing. If that's true, it might be a good idea to delay the purchase of equipment. And this does apply to everything but structures in effect, any tangible property but structures. So it might be a good idea to delay the purchase of equipment until 2018 when we actually do get a full expensing provision. Secondly, it is likely that tax will, if this gets passed, the tax will be reduced quite a bit. So that means that if you're in a position where you can take deductions now or later, probably makes sense to take them now because they're being used to reduce income that's taxed at 35% corporate and 39.6% individual. Next year, those deductions won't be worth as much because they would reduce income taxed at 15% lower rates. So accelerate deductions, delay purchases. Another thing you might think about is the proposal to limit net interest expense. And what that would do in effect is put debt on the same parity as equity. So currently there's a real incentive for companies to finance ever since '86. If you might remember the LBO craze of the late '80s, there's a real incentive to finance our operations through debt and tax deductible interest. And we even see that in private companies in the startup world. Well, debt, has its own issues. It has to bear interest. It has to be repaid. It ranks in priority over any equity. You tend to have to go get subordination agreements from your commercial lines and things like that. It's problematic, but there was a tax benefit. Well, if this interest expense goes away for C corporations as proposed, you might want to rethink your financing strategy and finance through equity when you can instead of through debt. Keep in mind, it's been proposed that there be carve-outs for small business and farms, and this is a proposal that applies to C corps at this point. Pass-through income. So as I said, pass-through income is going to be taxed at 25%, services income at 35%. So to the extent that you can justify a low amount of compensation, that'll decrease the 35% income that gets taxed and increase the amount of income that gets taxed as business income. So that's something to think about. And in fact, I go one step further. Now might be a good time to make an S election, right? Because the strategy in C corporations for small companies is that we empty everything out of the C corporation through bonuses or rents or deductible payments. That income reduces the C Corp income at 35% currently, gets picked up in individual income at a max rate of 39%, but it's blended, so it's probably lower. So it's pretty much a wash. It's not a wash anymore because C Corp income tax will be taxed at 20%, individual income at 35%. So that C Corp strategy doesn't work very well. So instead, you might want to make an S election if you can for that corporation, so that income gets picked up at the pass-through rate of 25% instead of 35%. I would suggest that everybody review their estate plan. Might want to think about, it's hard to, just stay on top of this. We don't know what the detail will be around estate tax repeal, but it comes up again and again. This is the one year we'll probably finally get it. I don't know what the trade-off will be for that, but it would be a good idea to stay on top of that. Because if it goes the Trump direction, that is going to create a lot of changes into how parties dispose of their estates, probably put a lot more pressure on planned gifting than we have right now. Thirdly, and I'm not being facetious when I say it's time to reconsider where you want to live. The state and local tax deduction is a big one. And if you're here in California, we've had tax increases in recent years. And it is a big bite, and even with deductible state taxes here, a lot of people have been leaving the state for Nevada, Arizona, Florida, South Dakota, maybe not South Dakota, but all the rest of those states. It's something to, when you sharpen your pencil, you might figure just how expensive it is going to be to live in a blue state if that state and local tax deduction goes away. And finally, I think we've covered all of the provisions. I guess the final thing is it's probably not too early. The tension's going to be for those of you who already are in pass-through entities to recharacterize your income as business income. The thought is around the pass-through income is that would only apply to manufacturing income, would not apply to services income, such as accountants and lawyers. So there is no planning that's going to be available to us. We're going to be taxed at the high rate no matter what. But that might have something to do with business models as you go forward, because there is a little bit of flexibility whether you're going to fit within this pass-through category or not. Okay, finally, who are the winners? Who are the losers? I think technology is generally a winner in this, right? The technology industry, I think the R&D credit is going to come out of this unscathed. There'll be full expensing, which is going to be a good thing. There'll be lower rates. That's going to be a good thing. So generally, technology, I think, is a winner. The only loser on that side is probably the non-deductibility of net interest expense. But I mean, who really funds tech companies with debt anyway? So I think tech generally wins. I think banking generally loses. This is because a lot of companies will be reevaluating whether bank financing makes as much sense as it used to. Real estate, it's a mixed bag. Full expensing and lower rates are going to be good for real estate. Non-deductibility of interest is going to be bad for real estate unless we can have some big carve-outs. I guess the good news is this is just proposed for C Corps, and not many C Corps own real estate. So it's a little, so the effect of the negatives will be widely outweighed, I think, by the positives. Retail, I think, is going to win. Lower rates and full expensing. Manufacturing, I think that again is a mixed bag, but mostly a winner because of the full expensing, the lower rates, and the territoriality that really affects manufacturing. Services, I think, is a loser in this scenario. That's the trade-off. Service companies generally are going to pay rates at the higher end of the spectrum. And even though we lose the AMT, which is an annoyance for services, we still have to deal with that state and local tax deduction.